All right, let's dive in. Today, we are cracking open the market's blueprint. We're going to walk through a really specific framework from ICT that shows you how to anticipate those big, higher timeframe price moves with a kind of precision you might not have thought was possible.
Welcome to AI Explains ICT. In this video, we're covering the key ideas from the core content, Month 5, Episode 14. And hey, I'd seriously recommend you grab a notepad for this one. I'm not kidding. The concepts we're about to go over, these higher timeframe PD arrays, are the absolute bedrock for any and all lower timeframe setups you're ever going to take. Get this right, and everything else starts to click into place. So let me ask you something. As a trader, what's that one single question you're always trying to answer? Every single time you pull up a chart, it's the same thing, right? Where is price going next? It's the puzzle we all live and breathe. And that question leads us straight into what I like to call the trader's dilemma, just trying to navigate the fog of market uncertainty. The real problem, and ICT points this out all the time, is that a lot of the traditional tools out there can actually create more confusion instead of less. I mean, think about it. You can show the exact same chart to 10 different traders using these common retail methods, and you'll probably get 10 completely different opinions. One trader sees a classic support line, another is pointing out a fib level, and a third is convinced a harmonic pattern is forming. That ambiguity, that's the enemy of consistent trading. We need to cut through that noise. So how do we do that? How do we get past all that conflicting information? Well, ICT offers a foundational logic, a way to look at the market like an algorithm. And it all boils down to two fundamental states: premium and discount. That's it. It's really simple. In a premium market, price is seen as expensive, it's overvalued, and the market's underlying program is actively looking for a reason to sell it off, to reprice it lower. You can think of this as your resistance zone. On the flip side, in a discount market, price is cheap, it's a bargain, and the algorithm is looking to buy it up and reprice it higher. That's your support zone. The market is just in this constant dance, moving between these two conditions. And right in the middle, the dividing line between those two zones is what we call equilibrium. This is the fair value price. It's a point of perfect balance. The market engine's job is to move price away from this balance point, pushing it up into a premium or pulling it down into a discount. That's what creates the moves we trade. And this visual here really says it all. At its core, the market algorithm is programmed to do one thing: move price from those cheap discount areas, your support, up towards the expensive premium areas, your resistance. It's a continuous delivery cycle. Okay, but that brings us right back to the million-dollar question, doesn't it? Knowing price wants to go from discount to premium is great, but where exactly in that premium zone is it going to turn around? Which specific level is going to stop it in its tracks? For that, we need a much more detailed map. And that map is precisely what ICT calls the PD arrays, premium and discount arrays. Think of these as specific price levels that act like magnets for institutional order flow. Let's start by looking at the premium arrays. This is your bearish checklist for resistance. So as price starts rallying up into a premium zone, it doesn't just bump into random resistance levels, it actually climbs a very specific ladder of these PD arrays. According to this model, it's going to encounter these levels in a specific order, starting from the bottom with a mitigation block and working its way up. This gives us an incredible blueprint for spotting potential reversal points. Now, the way to use this is absolutely crucial. You have to read this ladder from the bottom up as price is rising. The algorithm is first going to test the mitigation block. If it blows past that, its next target is the bearish breaker. If it gets through the breaker, then it looks for a void, and so on. It's a sequential checklist. And I really want you to burn this next rule into your brain, because it's a direct quote from ICT. The breaker is the most dominant array. What does that mean? It means if price rallies up into a bearish breaker, there is a very, very high probability that the move stops right there. It will often prevent price from ever even reaching a fair value gap or order block that's sitting just a little higher. So what is a bearish breaker? It's the last down candle just before price makes a higher high that runs out a previous swing high. This move is often a stop run, what ICT calls a turtle soup. When price eventually comes back up to that specific down candle's price range, it acts like a brick wall, a very powerful resistance level. Okay, so you get the logic for resistance, right? Now let's just flip this whole thing on its head, because the exact same hierarchical framework applies when price moves down into a discount. Now we're just looking for levels of support.
So if we look at the bottom half of our diagram, we see the bullish discount arrays. As price sells off below that equilibrium point, it starts descending a similar ladder, but this time it's a ladder of potential support levels. These are your go-to zones for looking for buy setups or for taking profit on your shorts.
And the process is identical, just in reverse. As price is falling, the first institutional support level it might hit is a mitigation block. If that doesn't hold, the algorithm will then target the bullish breaker. Now, the breaker will often give you a strong reaction, but if it fails, price could then continue sinking to fill a void or tap into a bullish order block further down. And a bullish breaker, as you've probably guessed, is just the inverse of the bearish one. It's the last up candle between two swing lows, where that second low raids liquidity below the first one. When price comes back down to this level, it often acts like a powerful springboard, launching price higher and preventing it from dropping into those deeper discount arrays. Now, this is where it all comes together. This is the part that really makes this framework so incredibly powerful. This isn't just some pattern that works on one chart. It is a universal, fractal model that applies with stunning consistency across all of the higher timeframes.
You can pull up a monthly chart, and this exact blueprint applies. This hierarchy, from mitigation blocks all the way to old highs and lows, is how you can frame the massive, long-term institutional order flow.
Then we can drop down to a weekly chart, and what do we see? The logic is absolutely identical. The same arrays, in the same order of importance, are dictating the flow of price. And it continues right on down to the daily chart. From the monthly to the weekly to the daily, you are using one single, unchanging framework to analyze price. This is how you eliminate the guesswork and start to align your analysis with the institutional perspective. It's a game changer. So let's just do a real quick recap of the most important takeaways here. First, price is not random. It's algorithmically seeking either premium or discount. Second, there's a specific ladder, a hierarchy of PD arrays that gives us a precise roadmap for its journey. Third, you should always be watching the mitigation blocks, and especially the breakers first. They are your highest probability levels. And finally, this entire framework is fractal and totally consistent across the monthly, weekly, and daily charts. So the last question I'll leave you with is this. Now that you have this blueprint, this hierarchical checklist for how price is delivered, how are you going to approach your charts differently tomorrow morning? If you found this video valuable, do me a favor and hit that like button, and be sure to subscribe to the channel for more content just like this. And hey, if you have any questions, seriously, drop them in the comments below. A real human will get back to you. Stay safe and happy trading.